Hi everybody. Welcome back to our series of video lectures about accounting for long-term contracts. In this video, we'll focus our discussion on recognizing revenue on a long-term contract that does not qualify for revenue recognition over time. This slide is the same as illustration 6-25B in your textbook. It shows the journal entries necessary to recognize revenue resulting from a long-term contract. It is the Harding example that we discussed in the prior video lecture. The top portion of this slide shows a single journal entry necessary to recognize revenue, cost of construction, think of that as cost of goods sold, and gross profit when recognizing revenue upon the completion of the contract. While the bottom part of the slide shows the journal entries that achieve this when recognizing revenue over the term of the contract. At this point, we'll focus on the structure of the journal entries, what is debited and what is credited. We'll discuss how to calculate specific amounts later. First, the same amounts of revenue. In this example, the $5 million contract price. The same amounts of cost and the same amount of gross profit are recognized whether it's over the term of the contract or only upon completion. The only difference is timing. To check this, we can add together all of the revenue recognized for both methods over the 3 years. $2 million revenue recognized in 2021. $1,125,000 revenue recognized in 2022. Plus $1,875,000 of revenue recognized in 2023 equals the $5 million of revenue for the entire contract. And if we were recording the revenue upon completion of the contract, we wouldn't record amounts in each year. We would simply wait and record the same $5 million when the construction contract was complete. Second, notice that regardless of the timing of revenue recognition, we always add gross profit, and gross profit is the difference between revenue and costs, to the CIP account, the Asset Construction in Progress account. That seems odd. Why add profit to what is essentially an inventory account? The key here is that when Harding recognizes gross profit, Harding is acting like it has sold some portion of the asset to the customer. But Harding keeps the asset in its own balance sheet in the CIP account until delivery to the customer. Putting recognized gross profit into the CIP account just updates that account to reflect the total value, cost plus gross profit equals sales price, of the customer's asset. But don't forget that the billings account is contra to the CIP account. Over the life of the construction project, Harding will bill the customer for the entire sales price of the asset. Therefore, at the end of the contract, the CIP amount containing total cost and gross profit, and the billings account, which is the contra asset account, containing all the amounts billed to the customer, will have equal balances that exactly offset to create a net value of 0. This $900,000 debit to construction in progress is the profit. That profit, that $900,000 profit, is the difference between the $5 million of revenue recognized minus the $4,100,000 of construction costs. If this is a contract that allows for recognizing revenue over time, then the same amounts will be recorded in journal entries, but the timing of the recognition is different. Instead of waiting until the job is completed, we're going to record a journal entry in 2021, another one in 2022, and a third one in 2023. The cost of construction in each of these years is the same that we saw in illustration 6-25 and shown on a prior slide. The cost of construction for 2021 were $1,500,000, for 2022 was $1 million, and for 2023 was $1,600,000. Those were given to us. For now, we are being given the revenue from the construction contract each year. Later, we'll learn how to calculate this revenue. Important to recognize right now, however, is that the $2 million of revenue that we're recording in 2021, plus the $1,125,000 of revenue recorded in 2022, plus the $1,875,000 recorded in 2023 equals the total $5 million of revenue that is required by the contract. And it's the same amount that we would have billed had we recognized the revenue upon completion. This construction in progress each year is a debit to the asset account, construction in progress, for the profit, each year's profit. And that's the difference between the revenue recognized this year plus the $1,500,000. Minus the $1,500,000 of construction costs, equals the $500,000 profit, which is debited to construction in progress. And the same is true for 2022 and 2023. So for the rest of this video, let's focus on this journal entry here, recognizing revenue upon completion of the project. If a contract does not qualify for revenue recognition over time, the revenue is then recognized at the point in time that control transfers from the seller to the customer, which typically occurs when the contract has been completed. At that time, the seller views itself as selling the asset and recognizes revenue and expenses associated with the sale. As shown in these two T accounts, the construction in progress or CIP T account is here, and the Contra asset account, billings on construction contract T account, is here. As shown in these two T accounts, completion occurs in 2023 for our Harding example. Prior to then, CIP includes only costs, showing a cumulative balance of $4,100,000 when the project is completed in 2023. These are the same numbers and coming from the same journal entries that we talked about in the prior slide. $1,500,000 of construction costs in 2021, plus 2022, $1 million of construction costs, plus 2023, $1,600,000 of construction costs. If we had a total right here, that would be total construction costs over the life of the contract, $4,100,000. Upon completion of the project, Harding will recognize the full $5 million revenue and the cost of construction, which is similar to cost of goods sold, of $4,100,000, because the asset is viewed as sold on that completion date. Harding includes the resulting $900,000 of gross profit in CIP, increasing its balance to $5 million of total costs plus profit. Now let's talk about the Contra asset account called billings on construction. These credit amounts were put into the T accounts or into the general ledger when we debited accounts receivable and credited billings on construction contract. Upon completion of the contract, we are going to need to make 2 journal entries to recognize revenue and zero out these 2 asset accounts. The first journal entry is to increase the construction in progress account for the profit and to recognize revenue earned on the contract and construction costs incurred as an expense. And that journal entry will be to debit CIP, the asset account, for $900,000 profit, debit an expense account called costs of construction for the $1,400,000 of expense, and to credit construction revenue for $5 million. The second journal entry is made to zero out the account balance in construction in progress and billings on construction contract, the asset and contra asset accounts, because the job is done. The building has transferred to our customer. We no longer have any inventory or costs associated with this completed project. And that journal entry is simply debit billings on construction contract, $5 million, and credit construction in progress, $5 million. And that will zero out the balance sheet account. Well, that's all for this video. In the next video, we'll discuss how to recognize revenue over time according to the percentage of completion using the same Harding example. See you next time.